Hello traders, Gary Wagner here, just after 12 noon in Honolulu, 6 o'clock in New York. It is Thursday, December 13th, 2018, and this is the Daily Report for gold and silver. We do have precious metals lower, moderately lower across the board, with gold currently down about 0.33%. Tracking at $1,246.30, net decline of $3.70. We are long from 1231. We will definitely talk about that as well as our stop when we pull up our technical studies. Silver down about 0.1%, about a 2-cent drop, dropping to $14.83.5. Platinum down 1.25%, back below 800 at $797, and palladium trading fractionally lower, giving up less than $2 at $11.9270. Now, that is all with very, very mild headwinds from a slightly stronger U.S. dollar, up nominally about 6 points at 97.08. And we did have the Dow Jones Industrial Average gaining a little ground, 70 points today at 24,597. But the Standard & Poor's as well as the NASDAQ both tracked lower. Standard & Poor's 2650. And finally, the NASDAQ losing about 0.4% at 70.70. Traders, undeniably, gold has been under pressure for the better part of this week. When we look at our weekly candlestick chart, we can see that this week's candle is definitively red. We are much closer to the bottom of the range than we are at the top. And even more important than that is the fact that the close is right at what I believe to be a pretty critical level of potential support, which was resistance at one point and then became support. Now, what you're looking at on this chart that is different from former fib retracements is I have the two data sets that I have been using, one an extremely long-term data set, and that data set actually begins at the end of 2015, beginning of 2016, when gold went to its lowest point after declining from 1900, and that was at about $1,000, $1,020. The second data set, the shorter of the two, fixes its bottom at the secondary low that was achieved at the end of 2016, beginning of 2017, at approximately 1124. So they're about $1,000 apart. The tops are the same for both. They are accounting for these multiple tops at 1370. What I look for when I do double data sets is something that I have labeled Fibonacci harmonics. Simply put, it is when two different Fibonacci retracements using different data sets, lengths, so to speak, come up with a number that is the same, meaning that they match up or align. And we can see that this is the starting point one here. The 78 is close to it, but it's certainly not on top of it. It is close, but not a true harmonics. The same when we look at this 0.618 and compare it to the 78. That is definitely not the same, and so forth. However, there is one point on this chart where we get a pure Fibonacci harmonics, and that is this particular area in which the longer-term 0.38% retracement and the shorter-term 50% retracement align within 40 cents of each other, and that, traders, is what I call a Fibonacci harmonics. When we get these harmonics, to me, that indicates that this particular price point is a little bit more critical than maybe this area here. So it is for that reason that I do believe that this is a key area that we need to see the market hold. Traders, we are looking at our daily candlestick chart. On this candlestick chart, we only have one fib retracement, and the one that we're using is of the shorter data set that goes back to the end of 2016, beginning of 2017, and puts 1246.40 in terms of its fib retracement at a 50% level. The other one, of course, was 38. We can absolutely see how closely the lows this week have really kind of hung to this particular price point, and after breaking above that former level of resistance, which I believe is now support. And this, of course, occurred a week ago Friday. We have seen this market have consistent lows that have challenged this area, but we have not had a closing price breach into this area. However, as we go into the last trading day of the week and with the FOMC meeting, which will begin next week, my sense is that we're going to want to move our stop. And the most logical place for me that gives us some protection and locks in a little bit more profit would be to place it right at around this 1240 price point. That is the low of the candle preceding the clip up, and we have not had a low that has come into this area. So my recommendation is to move your current stop, which is sitting at 1235.13 to 1240.13, moving it up in effect $5. Now, the caveat with that is that next week when the FOMC meeting begins and concludes, I expect them, to announce a rate hike, the fourth of this year, which is much more hawkish than the last two previous years, in which we have seen every 3 months being the pace at which we saw rate hike. But juggle that with a dovish tone or stance for future rate hikes and talk about the fact that interest rates are either near or at normalization. It's a balancing act that I'm going to be most interested to see how they word their statement. Nonetheless, we could see some enhanced or increased volatility as people absorb the fact that, yes, there's another interest rate hike that's bullish for the dollar and bearish for gold, but at the same time, a much more dovish stance for next year, which is bearish for the dollar and bullish for gold. So to juggle those two and to make sense out of it in terms of market participants is going to be an interesting week ahead. But we'll have to see how that all pans out. For the meantime, my recommendation, as I said, is to trail your stop to 1240.13. Maintain your current long position. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.